Howdy, Jacob here. Today we're looking at, I believe, Ennis, ticker symbol EBF. They have a $527 million market cap on $424 million enterprise value in the commercial services and supplies industry. Recently, their return on invested capital is averaging low double digits, so that has to be higher than there. It's very likely higher than the weighted average cost of capital, which is a positive, meaning that they're creating business, which is always good. Company offers snap sets, continuous forms, laser cut sheets, tags, labels, envelopes. So we're probably not going to see too much growth here or project too much growth here, but that makes sense for a dividend paying company. So 4.9% dividend yield. It is a smaller company, so I want to look at insider ownership, and we're seeing 4.2%. Not terribly high. Definitely prefer to see a bit more than that, but it's good to see that there's at least a little bit of skin in the game for management. Their net debt was very low, or in fact negative, and we see that they have zero long-term debt on 94 million cash equivalents on hand. Great balance sheet here. 94 million cash on hand in 62 billion total debt. Extremely positive on their balance sheet. From a cash flow perspective, very low capital expenditures with very healthy cash from operations. So their 5-year average free cash flow is probably high 40s. Let's just make it easy and say 50 million. They pay out 26 million in dividends. The use of cash flow is pretty heavy, about 50 to 60% on the dividend side, and then a little bit on acquisitions, a little bit on share repurchases. And then again, they don't have any debt anymore, so there's no repaying the debt since 2020. So I feel like that dividend with no debt is pretty safe, but I do want to see them with that excess 40 to 50% free cash flow going towards buying back shares when it's stupidly cheap, and then making acquisitions that are advantageous for the company elsewise. And then if that doesn't make any sense, then you just increase the one-time dividend or whatever it may be. But to me, I think I'm ready to start making some assumptions. I think I'm gonna guess some pretty low revenue growth and terminal P and price free cash flow because the industry they're in um, is just not very growth heavy, and so maybe they'll grow through acquisitions. That's where basically this is acquisitions, inflation, and then I think it's kind of a declining business, but we'll still probably see a little bit of revenue growth. And then margins have been going up on both the gross margin side and the operating margin side. That's positive to see, but I'll still be somewhat conservative and go pretty close to the average here and say 9% on the earnings side, 11% on the free cash flow side, and then maybe no share changes. They don't have any debt anymore, and their payouts 50 to 60%. I'm projecting 1% growth in revenue, so I'll project 1% growth for their dividends. And we get to a stock price that still needs to fall quite a bit before you get a 15% return given these assumptions. But everyone's different for why they purchase stock. And so to me, I think that the biggest things I look into for a dividend paying company are 4.9% dividend yield. That's great. Their balance sheet has no debt. In fact, their cash and cash equivalents is greater than all of their liabilities. So from a balance sheet, very healthy. And then from a payout ratio, we're looking at 50 to 60% of free cash flow going towards dividends. And the free cash flow is very consistent. And so not only do they have a lot of cash on hand if they were to weather a downfall year, but they're historically very consistent with their free cash flow. And so to me, the biggest things to look for are safety with dividends. If you're in retirement and you just want that excess free cash flow to sustain you, that's going to be extremely important. And I think we do see that here. And we also see sometimes, gains in that dividend per share, which is also very positive, meaning that, the share price may go up, so the yield may stay the same, but the actual dividend payout per share that you get is greater. And so I do think this is a company you should add to your dividend yield screener. But for me personally, I obviously care. I'm a young individual and I care more about the actual return. And so to me, if I were if I were in my retirement years, I think that this could give you probably pretty close to. I mean, you're not seeing a whole lot of percent, so even then, I'd still want it to drop a little bit. But um, everyone has different perspectives of what they need in purchasing stocks. But again, me, I'm looking for maximized returns. But again, I think this is a great company to add to your dividend yield list to possibly buy when the price goes down enough to where not only you're getting that solid yield on the dividend, but you're also getting good price appreciation through maybe share repurchases or reinvestment or increase in price earnings and free cash flow. And so to me, I'm just waiting, but I would definitely add this to your list if you're into dividends or just companies that are pretty healthy. So thank you and have a great rest of your day.